Hi everyone, welcome to Financial Insights. I'm Linda, your accounting coach. Today I want to give you 4 basic accounting equations you must know to run your business. One day I was talking to one of my aunts and we were talking about accounting or some type of other business concept. She stopped me and stated, "Talk to me like I'm 5 years old." In accounting or in business, we can get so bogged down into jargon, definitions, and we don't resonate with people to explain to them what's really going on. So I believe that's one of the reasons why most of us do not understand accounting. We get so bogged down in the jargon and not really making it simple, which is accounting is simple. Many of us handle our own books. And since we handle our own accounting books, we need to have some basic accounting knowledge. So we have to know common accounting equations. That's period. So today I want to discuss 4 common accounting equations you should know because these are numbers that the banks, grantees, other investors, other stakeholders look at. So these are just common numbers, common equations that you should know. You may have heard them when you read Forbes magazine or watch some type of business show. So let's get started. I have created a Excel spreadsheet and I'm going to share my screen because I think it's easier when you can actually see the equation. So I have an Excel spreadsheet. So the first equation you should know is net income. So net income is revenue minus expenses. Pretty simple. That's it. So if you're using Excel or if you still use calculator, which is fine, you're just going to take your revenue minus expenses. So if revenue is 5,000, expenses is 2,555, you're just going to subtract those numbers. Now, if the revenue is lower than expenses, you have a net loss. So if you have a positive revenue minus expenses, we call that net income. If revenue is lower, we call that net loss. So once again, if revenue is lower, it is a net loss. So that's number 1. The first equation is calculating your net income / net loss. The second equation you should know is profit margin. So profit margin is net income divided by revenue. So if your net income is 2,450 and your revenue is 5,000, your margin is 49%, which is pretty good. If in your net profit margin, there is no law or some type of statute that says, oh, your margin should be this. You have to look at your sector. So for instance, if you are in the IT arena, maybe you provide IT services, you need to look at other IT organizations and do some research and say, okay, most of the sector, they're run about maybe 30%, 20%. But I say if you're over, 10, 15%, that's a pretty good profit margin. And definitely if you're doing 49%, that's really good. So once again, profit margin is net income divided by revenue. And if you need to get familiar with Excel, I've actually showed you how to create that formula here. So if you look at the formula bar here, it is just taking net income divided by revenue, as I stated before. The third equation is cost of goods sold. So if you produce a product, once again, if you produce a product, not a service, if you produce a product, you need to calculate cost of goods sold. You should see that on your profit and loss statement. Cost of goods sold is your beginning inventory plus cost of new inventory minus ending inventory. That's a mouthful. If you're using accounting software, cost of goods sold is calculated for you, but you still need to understand the formula because you need to understand what is driving cost of goods sold. So cost of goods sold, just think about it is everything you buy to produce that product. So say for instance, your beginning inventory is 10,000. You go and purchase new inventory, 2,000. So your ending inventory is 8,000. Your cost of goods sold is the formula. So cost of goods sold is your beginning inventory plus cost of new inventory minus ending inventory. So your cost of goods sold is $4,000. Once again, if you are a service-based organization, you will not have cost of goods sold. Lastly, gross profit. Gross profit is revenue minus cost of goods sold divided by revenue. Once again, that's a mouthful. So once again, gross profit is revenue minus cost of goods sold divided by revenue. So if your revenue is 10,000, your cost of goods sold is 4,000, and once again, your revenue is 10,000, your gross profit is 60%. Similar to the profit margin, there's no law or statute that says, your gross profit needs to be this. You need to look at other similar organizations in your business and say, okay, my gross profit is in line to the sector, or that's what I'm expecting. So if you are expecting that your gross profit should be, let's say 10% and it's 2%, you need to go back and look at your revenue and cost of goods sold, because you could be putting in more money into cost of goods sold and not actually selling the product, which your revenue is not high. So hopefully that makes sense. So once again, your gross profit and your profit margin, you have to look at your sector, and then also you have to estimate and say, okay, you know what, my gross profit should be between 10, 15%, whatever it may be. Once again, if your gross profit is 60%, that's a good gross profit, similar to the profit margin. So the higher it is, the better. So once again, the higher the gross profit margin and the profit margin, the better. Also, just here for a bonus, sometimes entrepreneurs get tripped up on how to calculate increase and decrease. So for instance, I'm just using this as an example. So revenue. So say for instance, you're comparing revenue from 2020. So it's 140,000. And in 2019, it was 200,000. That's a 30% decrease. That formula, how you calculate increase and decrease, you're taking the current, I'm calling 2020 current, the 140,000 minus the 200,000 divided by the 2019 number, if that makes sense. Hopefully that makes sense. So once again, to calculate an increase or decrease, so maybe you want to do this for revenue or a particular expense, you're going to take what I call the current minus the prior, divide that number by the prior, and you'll get your percentage. This will, if you're able to include this in your monthly reporting, this is a game changer, because you will know, oh, my revenue increased by 10%, 15%. My expenses, went up by 25%. Let me see what's going on. So hopefully these formulas make sense. I'll go ahead and put those in the comment section so you know what those are all about. I am going to stop sharing and then go back over here to the video. So I challenge you to include these 4 equations in your monthly reporting. Your accounting software should calculate these numbers. I would also create a dashboard where you have these 4 accounting equations, and not only have it for the current month, but actually each month. I would have a column for each month for these 4 different accounting equations. Look at the trend and see what's going on. Ask yourself, why is it increasing? Why is it decreasing? Is it because my revenue was low? Is it because there's a particular season where customers don't purchase a lot? Or I had to purchase inventory, but the vendor charged more for it. So these are the questions and the digging that you need to understand your finances. So as I stated before, we have to have some basic accounting knowledge. Remember, your accounting software will calculate these numbers for you. They will record your transactions, but your accounting software, such as QuickBooks, will not do the analysis. So use your accounting software, let that software calculate these numbers for you, but understand, as I say, peel back the onion. What's driving that number? Make sure you subscribe to our YouTube channel to view more mini lessons. Hope you enjoy. See you next time.